Imagine this. You've got $50,000 sitting in a savings account, earning you maybe 4% interest, which sounds fine until you realize inflation is quietly eating through it like termites in a house you don't even know is rotting. You've been responsible, you've saved, and yet somehow you feel further behind than you did 5 years ago. Your friend from college just bought his second rental property. Your coworker keeps talking about how her index fund is up 30% over 3 years. And you're sitting there thinking, okay, what am I actually supposed to do with my money? Real estate? Stocks? Both? Neither? Here's the thing. This is the exact question that holds more people back than almost any other in personal finance. Not because the answer is impossible to find, but because everyone you ask gives you a completely different answer, and most of them are wrong. Not maliciously, they're just telling you what worked for them, in their specific moment, in their specific market, with their specific temperament. And that's not good enough for you. My name is Zach, and I spend way too much time thinking about how everyday people build real wealth, not lottery ticket wealth, not Instagram flexing wealth, but the kind of slow, compounding, boring wealth that actually changes your life 20 years from now. If you're someone who's tired of being confused by financial advice that seems to contradict itself every time you turn around, hit subscribe and give this video a thumbs up. We are going to break this down properly today. Here's what most people don't realize. This debate between real estate and stocks is not actually a math problem. Well, it partly is, and we're going to do the math, I promise. But at its core, this is a psychology problem. And the reason most people pick the wrong option for themselves isn't because they ran the numbers incorrectly. It's because they never asked the right questions about themselves in the first place. So, let's start with the numbers. The S&P 500, which is the most commonly cited benchmark for U.S. stock market performance, has returned an average of roughly 10% annually since its inception, including dividends. Since 1928, stocks have averaged about 9.9% per year. Now think about what that means over time. If you had invested $100,000 in a low-cost index fund tracking the S&P 500 30 years ago and never touched it, you would have somewhere in the neighborhood of $1.7 million today. You did nothing. You touched nothing. You just let it compound. Now look at real estate. The national picture on home price appreciation alone, purely the price going up, has averaged about 5.4% annually from 1928 through 2024. But wait, before the real estate crowd starts typing angry comments, that number is misleading. Because when you actually own investment real estate, you are not just making money on price appreciation, you are making money on rental income, on tax advantages, on debt paydown, and most critically, you are making money on leverage. And leverage changes everything. Here's where it gets interesting. Let's say you have $100,000 to invest. Option 1, you put it straight into an S&P 500 index fund. Let's call it a 10% annual return. After 1 year, you've made $10,000. After 10 years, that $100,000 has grown to about $259,000, assuming you reinvested everything. That is genuinely great. Option 2, you use that same $100,000 as a 20% down payment on a $500,000 rental property. Now the math shifts dramatically. That property grows at, let's say, 5% per year, a conservative number. After year 1, the property is worth $525,000. You made $25,000 in appreciation, but you only put in $100,000. That's a 25% return on your invested capital, not 5%, 25%. Why? Because you're making returns on $500,000 while only having $100,000 of your own money at work. That is the leverage effect, and it is the single most powerful argument in favor of real estate that most financial influencers conveniently forget to mention. You literally cannot do this with stocks. You cannot walk into a brokerage, hand them $20,000, and control $100,000 in equities without taking on margin debt, which comes with brutal interest rates and the terrifying possibility of a margin call that forces you to sell at the worst possible moment.
Now, you might be thinking, okay, Zach, but real estate has all these extra costs. And you're right. This is exactly where I need to pump the brakes on the real estate side, because this is exactly where most new landlords get absolutely destroyed. Let's talk about what real estate actually costs you, because the number most people quote when they brag about their rental property is the gross rent, not the net return, and there is a massive difference between those two things. Take a $300,000 rental property. Your mortgage payment, taxes, insurance, and basic maintenance, let's add those up honestly. Property taxes might run you $3,600 a year on that property, which is about $300 a month. Landlord insurance, figure another $1,500 to $2,000 annually. Maintenance and repairs, the rule of thumb is to budget 1% of the property's value per year. On a $300,000 home, that's another $3,000 sitting in reserves, and that's just for the expected stuff. An HVAC failure can run you $500 to $3,000 in a single call. A roof replacement, anywhere from $8,000 to $20,000, depending on where you live. Then there's vacancy, because here's what most people don't think about. Your property is not going to be occupied every day of every year. The standard planning benchmark is a 5% annual vacancy rate. On a property renting for $2,000 a month, that's $1,200 in lost income, just sitting there as an empty unit with no one paying the bills while you still owe the mortgage. And then, and this one hits hard, there is the time cost. Landlords spend roughly 5 hours per month managing a single property. Maintenance coordination, tenant questions, lease renewals, repairs, accounting. That's 60 hours a year. What is your time worth? If you value it at $30 an hour, you're spending $1,800 of your life managing one property. Most people never count that. If you hire a property management company to handle all of this, which is smart, and honestly probably necessary if you want real passive income, they're going to charge you 8 to 10% of gross rent. On a property bringing in $2,000 a month, that's $2,400 right off the top. Add it all up, and the passive income real estate investor with a $300,000 property renting for $2,000 a month is often netting much less than they think once you account for the mortgage, taxes, insurance, maintenance reserves, vacancy, and management. The math still can work, it absolutely can, but only if you go in with your eyes fully open, which most people do not. Here's the thing about stocks that people underestimate. Simplicity is a superpower that nobody respects until they've owned a rental property. Open a brokerage account, put money in a low-cost index fund, done. No tenants calling you at 11 at night because the water heater is making a noise, no scrambling to cover a mortgage payment when your tenant stops paying in month 3 of a difficult eviction process, no dealing with surprise assessments, HOA disputes, or the emotional whiplash of watching a property you love deteriorate because someone is living in it who doesn't love it the way you do. And here is the psychological truth that nobody says loudly enough. Most people are terrible at staying invested in stocks because the volatility is terrifying in a way that makes them do exactly the wrong thing at exactly the wrong time. The S&P 500 dropped nearly 50% during the 2008 financial crisis. It dropped over 30% in March of 2020 in a matter of weeks. And every single time that happens, millions of perfectly intelligent people sell. They lock in the losses, they sit in cash, they wait for it to feel safe again, which by the time it does, they've already missed 30, 40, 50% of the recovery. Studies consistently show that the average investor earns significantly less than the average index fund return because behavior destroys performance.
Real estate has its own version of this problem, but it works in the opposite direction. Because your property doesn't have a ticker on the screen refreshing every second, you don't panic sell. You can't panic sell easily. The illiquidity, which most people think of as a flaw, turns out to be a psychological protection for a lot of investors. You just keep collecting rent, paying down the mortgage, and watching equity build, even during rough markets. Now, you might be thinking, okay, Zach, this is all interesting, but just give me the answer. Which one wins? Here's the honest answer. Over the past several decades, the data leans towards stocks winning on raw return when you measure pure price appreciation. From 1980 to 2024, the S&P 500 rose by over 313% in the most recent decade alone, while the Vanguard Real Estate Index rose only 42% in the same period. But here's the thing. That comparison is incomplete. It ignores leverage, it ignores rental income, it ignores tax advantages, and it ignores what actually happened to real human beings with real psychology trying to invest in both of these things. What the research actually shows is that REITs, real estate investment trusts, which are publicly traded companies that own real estate, averaged about 11.8% annually from 1972 to 2019. That outpaced the S&P 500's 10.6% average return over that same period. And according to data from Nareit, when you measure holding periods of 19 years or more, REITs have outperformed U.S. stocks every single month going back through the modern REIT era. Every single month. That's not a knock on stocks. That's just a more complete picture. Here's what most people don't realize about this debate. It's a false binary. The most financially successful people you will ever meet are not the ones who picked the right asset class. They're the ones who understood their own temperament, their own financial situation, and their own life goals clearly enough to match their investment strategy to who they actually are. Think about it this way. Real estate is like owning a restaurant. You have a physical product, you have customers, you have overhead, you have employees, and you have real leverage over the outcome. If you're willing to put in the work, stay educated, and manage it actively, the upside is tremendous. Stocks are like owning a piece of every restaurant in the country simultaneously, without ever having to show up to work a single shift. Less control, less leverage, but also less work, less risk of a single bad location destroying you, and complete liquidity whenever you need it. Both of these can make you rich. Neither of them will if you don't have the discipline to stay in the game long enough for compounding to do its work. Let me give you the actual framework you should use to make this decision for yourself, not for some hypothetical investor, but for you, right now. First, ask yourself how much liquid capital you have and how much you can genuinely afford to lock up. Real estate requires a significant upfront investment. A 20% down payment on an average U.S. home today is somewhere around $80,000 to $100,000. Then closing costs, inspections, initial repairs. You are looking at getting in the door for a minimum of $80,000 to $120,000 in most markets. If you don't have that, the real estate debate is premature. Start with stocks. The barrier to entry is essentially zero. You can buy a fraction of an index fund for $5. Second, ask yourself about your time and temperament honestly. Not optimistically, not "I'll hire a property manager," honestly. Do you want to be in the landlord business? Because that is what you are signing up for. You are becoming a small business owner with all the complexity that entails. If the idea of that genuinely excites you, great. Lean into real estate. If the idea of dealing with tenants, maintenance, and property management makes you want to take a nap, lean into index funds and let the market work for you while you sleep. Third, think about your timeline. Both real estate and stocks reward patience, but real estate requires a longer minimum holding period because of transaction costs. Buying and selling a property can cost you 6 to 8% of the sales price between agent commissions, closing costs, and other fees. You need to hold long enough for appreciation and cash flow to overcome those costs. Stocks, you can buy today and be liquid tomorrow if you need to be. Fourth, think about diversification. Owning a rental property in one city means your financial performance is heavily tied to that one local market. Owning an index fund means you own a piece of hundreds or thousands of companies across every sector of the economy. The risk profile is very different. And fifth, and this is the psychological one that most people skip, ask yourself what will make you stay invested when things get hard. Because things will get hard. The market will crash, your tenant will stop paying rent, interest rates will rise, repairs will cost more than you planned. Whatever your investment is, you will face a moment where every instinct in your body tells you to quit. The best investment is the one you can actually hold through that moment without losing your mind or your nerve. Here is my honest take after spending way too many hours thinking about this. For most people starting their wealth-building journey, index funds should be the foundation. They are accessible, diversified, low-cost, and psychologically forgiving in a way that removes the biggest threat to your returns, which is you making emotional decisions. Once you have a solid foundation in the market, real estate makes an extraordinary complement, not instead of stocks, alongside them. The leverage, the tax advantages, the forced savings mechanism of paying down a mortgage, these are genuinely powerful tools that stocks simply cannot replicate. The people who win at this game long-term are not the ones who went all in on one thing. They're the ones who built a diversified wealth engine that works even when they're not watching it. You already know the biggest mistake people make. They do nothing. They argue about real estate versus stocks for years, while inflation quietly erodes the money sitting in their savings account. The second biggest mistake is letting someone else's preference become your strategy. Your neighbor's real estate portfolio was built for his income, his risk tolerance, his city, his personality. Your coworker's index fund strategy was built for her timeline and her temperament. Neither of them is you. You are building something for yourself, for your family, for your future. The question is never, what is the objectively best investment in the world? The question is, what is the best investment for the person I actually am? And what am I willing to do consistently for a very long time without giving up? Answer that honestly, and you have already won more than 90% of the people who started watching this video. Now go build something. If this video helped you think about this differently, hit that thumbs up. It genuinely helps more people find it. And drop a comment below. Are you team real estate, team stocks, or are you building both? See you in the next one.